Vega is the volatility factor. Volatility is a measure of how a security's price is moving up and down. If a stock price fluctuates all over the place in wild swings, then a high volatility is predicted. The greater the volatility, the greater the risk, the more expensive option premium become. Volatility are of two types, historical volatility and implied volatility. Historical volatility is the annualized standard deviation of past price movements of the stock. It is based on underlying asset volatility over a period of time. For example, the past 20 or 30 trading days. We use historical volatility as reference for calculating the fair value of option. But in real world, option premium frequently trade away from their fair values and driven more by demand and supply. So the implied volatility is more important than historical volatility. The implied volatility is derived from the market price of the option itself. And Vega is the amount option price will change for 1 point change in implied volatility. It is a measure of uncertainty in the markets. When a big news is expected, there is uncertainty in the market about the news. So the volatility also increases. And with the increase in volatility, option premium also increases. After the impact of news, volatility decreases and option price also decreases. This is where most traders lose money after the impact of news. It is only Vega that has such a big effect on options that sometimes even the direction is right, an option buyer loses money because Vega decreases. Long strangles and long straddles are very useful strategies in this scenario. Vega is approximately identical for both call and puts. You can see this is the value of Vega for call and this is the value for Vega for put option. Vega is high for at the money option and near the money options, and Vega reduces when option approaches to the expiration because there is less time for increased volatility to make an impact on the time value of the component. When volatility is at peak, we should sell options because both the Vega and theta helps the option sellers. The conclusion is increasing Vega increases the option price and a low Vega have a low option price for the same theta and delta. This was a brief discussion about Vega. Thanks for watching the lecture.